Good afternoon, everyone, and thanks so much for joining us at our, I think, second of Communities of Practice Zoom event for the new world in which we live. Appreciate you taking the time, and I'm sure that you will find it time well worth spent because we have a presenter extraordinaire, as you all know, in our wonderful General Manager of the AFA Policy, if I can get the words out, General Manager of Policy and Professionalism, the one and only Mr. Phil Anderson, to actually give an update on the huge number of regulatory changes that have either just been implemented, are midway through being implemented, or about to be implemented in the next couple of months. So I know that you will get a lot of information this afternoon. Please feel free to
I think you've been muted.
All good now?
Yes.
Awesome. I don't know where we got up to, but we have Phil Anderson presenting on a lot of things this afternoon. You'll get a lot of information. In terms of asking questions, if you could avail yourself of the chat line on the Zoom call, that will allow a couple of our fabulous AFA committee members to collate the questions and put them to Phil at a number of breaks throughout the session. And then I'm sure at the end, if there's anything that we haven't covered, please feel free to continue to input anything into that chat line. And if we don't get through it in the time permitting, we'll certainly come back to you. And just to cover off what Phil will be covering, first of all, some great news around the ASIC funding levy. He'll then be speaking to the FSC changes with the changes to medical consent, which I'm sure a lot of you are already across because you would have had to have used them already in your own practices. DDO, IDII, annual agreements and breach reporting. So without any further ado, I'll very happily hand over to you, Phil.
Great. Thanks, Julie. And good afternoon, everyone. It's fantastic to have you all participate in this exercise. But look, I'm going to start off with a quick message about some good news. I think it's worthwhile every time we get some good news to spend some time to celebrate it. And obviously earlier this week, we got the news that the ASIC funding levy was going to be reduced for 2 years, the 2020-21 year that we've just finished, and then the 2021-22 year that we've just started. Now, that's really important. It's going to save advisors probably at least $2,000 for each of those years. We were told by ASIC in late July that it was going to be $3,138 for the 2021 year. We knew that was an underestimate because they'd used the wrong number of advisors to work it out. So we thought it was probably more likely to be $3,450. So we're going to see at least $2,000, probably $2,200, $2,300 saving because you will pay just $1,142. Now, I'm sure, like any wins, there's many fathers of this particular outcome. We would like to think that we played an important role in it. We have been communicating with the minister both in writing and face-to-face on it a number of times. We have been working with many of the backbench politicians to get them to push the issue through parliamentary hearings. And I think, as we said in our message to members on Monday, to have 50 minutes of the PJC on corporations and financial services hearing focused on solely the ASIC funding levy for financial advisors was a clear sign of how intense this issue had become. So I was very pleased when I was contacted on Sunday afternoon to say that there was a solution being delivered. Right, that's the good news. Now let's jump into the rest of the issues that we've got this afternoon. So we're going to start with the FSC change to medical consent. This is an issue that emerged out of a parliamentary Joint Committee on Corporations and Financial Services that ran 2016, 2017, and was specifically looking at life insurance. And one of the recommendations of that report was that the FSC should work with the Royal Australian College of GPs to agree on a standardised consent form for accessing medical records and medical history. And one of the concerns expressed during that particular inquiry was life insurers accessing information on clients that was not necessarily relevant to the matter that was being considered. So the FSC and the Royal Australian College of GPs worked on this standard, which was agreed in 2019. Ultimately, it became effective on the 1st of July this year. It's called Standard 26, and all of the life, FSC Standard 26, and all of the life insurers are now required to follow it. There are two types of authorities. The first one enables a life insurer to request specific or general reports or other reports or documentation, but it explicitly excludes them from simply asking for all consultation notes. There is a second authority option that's available, and this is one that allows life insurers to get the full medical history of the client, including those consultation notes, but it only applies where they've been unable to, or the medical practitioner has been unable to, or has failed to provide it within a 4-week period, or in circumstances where the report was incomplete or contained inaccuracies or inconsistencies. So that's the new regime that's in place. It only applies, obviously, in the context of underwriting new business or claims. And each time a life insurer wants to access that information, they have to get a new consent. So that's pretty much the situation with that reform. You'll see standardised forms being used by all of the life insurers. I don't know, are there any questions on that one?
No, there's no questions, Phil, yet.
All right, well, if that's the case, then should we push on with the second issue, which is the design and distribution obligations?
Yep.
Good, all right. This one is going to be a big one. So it starts on the 5th of October, but it will certainly have a material impact on advisors. Obviously, it'll have a big impact on product providers. It actually came out of the financial system inquiry in 2014, and it reflects some of the things that are happening overseas. Now, the Treasury Laws Amendment, Design and Distribution Obligations and Product Intervention Powers Bill 2019 was passed back in April of 2019, but it had a 2-year transition. And then last year, during the middle of COVID, ASIC decided to provide another 6-month extension. So it actually commences from the 5th of October, so a little bit over 5 weeks' time. Now, the DDO, the design and distribution obligations, apply to both product issuers and distributors. And financial advisors are classified as distributors. So I know we don't necessarily like to think of our profession as a distributor. We're an advice provider profession, but that's nonetheless the way the law has classified advice in this context. So I'll talk about the product issuer obligations and also the financial advisor obligations. So first of all, product issuers, they have a requirement to produce a target market determination for each of the applicable products. And I'll talk more about that in a moment because it's virtually all of the products. So this is a document that defines who is the most suitable clients for that product. And it looks at a range of things. Where if it's investment, it's tolerance to risk, it's their need for breadth of investment options. There might be age considerations and stage of life considerations. We'll wait and see how some of the detail of this will actually come out. All right, so let's now just go through the other parts of it. There's a requirement for the product issuer to regularly review those target market determinations to make sure that they remain appropriate. And this is designed to make sure that they're focusing on the right clients, or the right clients are ending up in their products. So also they have to specify for distributors what the reporting requirements are going to be. So that's a layer of complexity that we'll come back to, but it's the product providers that define what the distributors need to provide. Product providers also need to notify ASIC about significant dealings, which we'll come back to, and they need to take reasonable steps to ensure that all the product distributors are complying with the target market determination requirements. Now, importantly, the Financial Services Council has produced some templates for target market determinations, and these are across a range of different products. It includes life insurance as well. So they've prepared templates for the different types of life insurance products. Now, distributors have a different set of obligations. They have a requirement to take reasonable steps to ensure that the clients are consistent with those target market determinations. Now, there is an exemption from that requirement for financial advisors, and I'll come back to that in a moment. Distributors also have an obligation to notify product providers of significant dealings, and that's a requirement that applies within 10 business days. They have to provide regular reporting to product providers, including and specifically about complaints, but also potentially other matters as defined by the product providers. And those reporting requirements could differ from one product to another, and they'll be detailed in the target market determination. And there's also record keeping obligations that apply for 7 years. Now, DDO applies to most products, certainly most products that financial advisors deal with. There are some notable exceptions. MySuper is exempt, but also, strangely enough, margin lending, which you would have thought was a higher risk product. Ordinary shares are also exempt, whereas hybrid debt securities aren't exempt. Now, we talked about there being an exemption for financial advisors, and that is because financial advisors have the obligation to comply with the best interest duty. So the law formed the view that they wouldn't need to play this role in terms of ensuring that each client complied with the target market determination. And that's because you do have other obligations that are at a professional level. So you don't necessarily need to make sure that the client does comply with that target market determination. The complication, however, though, is that that exemption is very specific to personal advice. And so it doesn't apply in the case of general advice, and it doesn't apply in the case of execution-only transactions. So seemingly product providers need to get confirmation that a product was provided or issued in a personal advice context in order to allow that exemption to actually apply. So that is one real complication in this whole process. And look, from our perspective, if every time you are involved in a transaction, you need to confirm that it's a transaction done on the basis of personal advice, then having the exemption from needing to comply with the requirement to take reasonable steps to ensure that the client was consistent with that target market determination seems to really reduce the value of having that exemption. Right, reporting is going to be the big issue here. And I particularly emphasise that for small licensees, because you'll need to be reporting as frequently as every quarter, and this is to each product provider. So if you think about small licensees, they're going to have a lot of reporting to do. Now, if they're a small licensee with a broad approved product list, they could have a lot of reporting to do. And it could very well be the very vast bulk of it is a nil report. And that's another part of this regime. You're still required to do nil reports. The reporting is going to seemingly be predominantly focused on whether there are any complaints. And small licensees could go for years without complaints. So needing to provide all these nil reports to all these product providers every quarter will be particularly challenging. Now, I talked also about the requirement to provide reporting on significant dealings, and we don't actually know precisely what significant dealings are. It's not defined in the law or defined by ASIC, and it may be the target market determination talks to some of it. It might be that it needs to reflect upon the extent to which the client may not be consistent with that target market determination, whether it's a slight variance or a large variance. It might also be about the scale of the transaction. So at this stage, it's another unknown in it, which is going to add complexity. But it's important to know that if you do have a significant dealing with a client that is, and their use of the product is inconsistent with the target market determination, that it could well add to the complexity of reporting. Now, record keeping is another thing that advisors are going to need to consider, and obviously this is going to work through the licensee because it'll be the licensee that does the reporting. So look, at my summation of this is for a new regime that's been designed supposedly to protect the interests of clients, for clients of financial advisors, it's difficult to see where there'll be any benefit. It's just going to add complexity and cost to the process. So what I'm suggesting to you is certainly keep an eye out for the communication that you'll be getting from product providers over the next month in the lead up to this getting underway from the 5th of October. It'll be a significant administrative additional workload for the advisor and licensee sector. So happy to take any questions on DDO.
Okay, Phil, we have a couple of questions. The first one asked is, how does a combination of products fit in where the personal advice is provided and the structure meets their needs? So basically from what you said, if it's from an advisor, does that mean there's some form of exemption with respect to that?
So I'm just guessing that this question with the reference to a combination of products, and it might be that you've got a client who has more of a conservative risk profile, but they have a few growth elements to it. And that might make up a small proportion of the total investment portfolio. And the question is, do you need to view them in isolation, or do you need to view it as the portfolio as a whole? I think the answer is you can view it as the portfolio as a whole, but it does add extra complexity to it. And once again, it's in the financial advice context, because you're bound by the best interest duty, you do not need to ensure that each individual product is consistent with that client's alignment with that target market determination.
Thanks, Phil. Another question, do we have any examples of how the product providers expect to receive this reporting from the licensees?
I don't know the answer to that. I think we've started to see the target market determinations being issued, but I haven't seen anything that talks about the exact format that it might take. So I think that's something that we're going to see more of in the next month, you would certainly hope that it could be done in a way that is very much automated, and particularly if you're dealing with a whole bunch of nil responses. But I make the point that the law has been designed in a way where it's the product issuer who is defining the requirements for what needs to be reported.
Thank you, Phil. That's it for questions on DDO. Thank you.
I'm not sure. I'm getting a bit of feedback that there are people who can't get in today, and they're getting a message that that there's a capacity of 100 participants.
Yeah, Mel's aware of it, Phil. She's attempted to fix it at the back end, but I'm not sure whether that will be successful or not.
Right. Okay. All right. Well, we'll keep pushing ahead then.
Yes, please.
Okay, Karen, were there any more questions on DDO?
No, there's no more questions. Thanks, Phil. You covered off on all of them. Thank you.
Is there just a question there about reporting via RAPs? Is that different?
No.
And look, I would assume that the reporting obligation is at the RAP level, not the individual product level. But we'll wait and see for more guidance on that.
Did you just see the message, Phil, that just came up? Phil, I believe we need to ask for a time period between the product provider and issuer, as we have not had time to massage reporting or even analyse TMD DDO as yet.
Yeah, and look, I think that's a really fair point, that this is a significant additional obligation that has been put in place. And it's pretty tough, I think, on all distributors, but particularly financial advisors, because it's the product providers that are defining exactly what the requirements are going to be. And so they could be different from one product provider to another. Fortunately, I think the FSC have been working on trying to standardise as much as possible. But I think the other point to emphasise is that ASIC has recently come out and made a statement recognising the fact that there's such a substantial amount of regulatory reform that is kicking in the same time frame. So we've got 5 key things happening either on the 1st of October or the 5th of October that advice is focused on. There are other things happening elsewhere. So ASIC have come out and said, in effect, that they're going to provide a facility of compliance approach. And this is a message to say that they understand that it's going to be really difficult and challenging. So as long as you are at least making a reasonable effort to comply, they're not going to take enforcement action against you. So I think it's something that licensees will need to give due consideration to, is how they demonstrate that they have taken reasonable steps, even though it's inevitably going to be very difficult at the outset, particularly because it hasn't been possible to prepare well in advance for this, because we've needed to wait for the target market determinations from each of the product providers.
And finally, will the AFSLs be liable if they don't provide the reporting because the product providers haven't told them the information they need or how they want to receive it by the due date?
Yeah, I think it's a really good point. And one of the things that my thinking about it from the start was can we start charging product providers for collecting this information from them? But let's put that issue to one side. But on that point, I'll come back to what ASIC have said in their statement about the facility of compliance approach. And we had ASIC in front of the PJC last Friday, and the new chairman, Joe Longo, specifically referred to that. So they are going to be necessarily needing to take a facility of compliance approach, not pursue action against people who have made every effort to comply but were constrained for whatever the reason would be. But particularly if you haven't been told or you haven't had time to prepare, then I think that's a very defensible position.
All right, thanks, Phil. If there's any other questions, we'll get back to them. Thank you.
All right, fantastic. Well, I might then push on with our third item, which is the APRA intervention in the income disability insurance, individual disability insurance market. So the income protection product. So if I go back to the origins of this, we knew in 2019 that APRA was having a close look at the income protection market, and were particularly concerned. By November of 2019, they came out and made a statement, and we've talked about this as the APRA intervention measure since then. At that time, they referred to the fact that the income protection market had lost $3 billion over the course of the previous 5 years and $1 billion in the year to 30 September 2019. So APRA had got to the point where they felt that they needed to intervene in the market. Their ability to intervene is reasonably limited, but the way they've done it is through the powers that they have to require capital backing for products. So they can define how much capital a product provider needs to have, a life insurer needs to have for particular products. And they've used that as the lever to get all of the life insurers to comply. So yeah, ultimately it comes back to the life insurers needing to put more capital behind their products if they haven't achieved the requirements of APRA. Now, the key changes as they defined back at that point was probably in 4 key areas: changes to the assessment of income at risk. So they banned agreed value, or they plan to ban agreed value, and they plan to limit other clients to indemnity cover assessed on the basis of the last 12 months. Now, subsequent to that, they did provide, when they finalised it, a little bit more flexibility for people who have variable income, and that will be with the life insurer to assess what is a reasonable period for that to be assessed across. But obviously, there'll be advisors who work with rural clients who their income depends upon how much rain there is, and it can be very variable from one year to the next. There'll be many other circumstances, small business operators, where their income is variable depending upon whether they get a good run or not, or whether they have a big contract or not. The second part of it was income replacement ratios. Now, ultimately, APRA have defined an income replacement cap at 90% for the first 6 months and 70% thereafter. However, that also applies to super contributions. So you can have that applied to the 10% super as well. The proposal was that contracts would need to be refreshed every 5 years. And this means that they need to be underwritten again for financials, for occupation and for pastimes. Importantly, those 5-year refreshes do not include underwriting for health. So a deterioration in health will not be the basis for the cover to be rejected. And also, fourthly, the introduction of control measures around long benefit payment periods. And I think that reflects the fact that APRA was very concerned that some people going on to income protection claims were staying there for a long period of time, and that was impacting the profitability of products. So agreed value cover disappeared, well, at least new agreed value cover disappeared from April of 2020. So you can now no longer sell agreed value, although obviously there's quite a lot of agreed value cover that's still out there, and advisors are constantly working with their clients to hold on to those much more valuable older products. So that was phase one. The second phase was originally scheduled to be the 1st of July 2021, but it was subsequently pushed back to the 1st of October 2021. And there was a further change in May of this year. APRA decided to give life insurers another 12 months to resolve how they were going to enact this requirement that policies be refreshed. And I'm using the term refresh. They're effectively new contracts every 5 years. So life insurers are not required to include that in their solutions that are due to start on the 1st of October this year. Now, there is another layer of complexity in this particular piece of work, because the Actuaries Institute has been doing a lot of work in this area, and particularly looking at what has been driving the losses in the IDII market. And they have, in April this year, issued what's called a reference product, which is their preferred design of income protection products. Now, I just take you through some of their recommendations, because we're likely to see some of these elements incorporated in the products that we see from the 1st of October. So just to go through some of the detail, they have suggested even tighter income replacement caps than APRA have, and they've also proposed that they would scale back as the income increased. So their suggestion was it should be 60% for the first 240,000, although noting it would be 75% for the first 6 months, 40% for the next 240,000, so between 240,000 and 480,000, and then only 20% of the income for the next 480,000. And then by the time that you get to 960,000, anything more than that would have nil cover. So it's quite a substantial change to the 70% flat that was proposed by APRA. So it'll be interesting to watch to see how this plays out in practice. The actuaries also suggested a limitation of own occupation for just the first 2 years of the benefit, a waiting period of between 30 days and 180 days. So this means you could no longer recommend, if this was enacted by the life insurers, a 2-year waiting period as a mechanism of reducing the cost of the cover. The benefit period will be limited until age 60. And they also endorse this idea of updating the terms every 5 years. So I just make the point that the Actuaries Institute reference product recommendations are not law. Obviously, they don't have the basis of law. However, we're going to wait and see the extent to which the life insurers decide to use some of these recommendations. And we've already, I think, seen some of the life insurers suggest that they will take on some of those measures that they have proposed. So I'm just highlighting for you that the Actuaries Institute have also likely had a fairly important impact on the design of these products. And they will, no doubt, will see those in the products that get released from the 1st of October this year, although maybe there's possibility for further changes in 12 months' time. Now, one thing that I do want to emphasise is that we have a session at the conference on these changes to the IDII market. We're going to hear from the Actuaries Institute. We're also going to be hearing from Integrity Life as one of the life insurers and other key people in the sector to give us some really useful guidance on what it's going to look like. That's 3 weeks from now. We'll know a lot more about the products that are available then. Now, one thing that I really do want to emphasise when we talk about the APRA intervention is how much this will add difficulty to the advice process. We're really conscious of the difficulty of the trade-off that will be there between the current products, which have better features and terms. However, they are subject to increasing premiums, and we've seen very substantial premium increases across some of these products. So, you know, there's that. Good products, expectation of premium increases, and comparing that with the new products, which hopefully will be more stable in terms of pricing, and we certainly would expect that, but the terms won't be as good, and there's that uncertainty as to what might happen when you get to that 5-year mark and the policy is rewritten or renewed or refreshed. So look, there's going to be quite a lot of complexity in this, and the challenge will be for advisors in making the decision, do we move clients from the existing products to the new products? And in what circumstances might we do that? And what are the risks involved in it? So we're going to talk a little bit about that at the conference, but it's something to be very conscious of, and being aware of the risks that might be involved in it. Now, just another thing before we move to questions, just to reflect upon some recent data from APRA on the profitability of the life insurers. The loss made in the IDII product had fallen from $1.288 billion for the 12 months to 30 June 2020, back to a loss of $345 million for the 12 months to 30 June 2021. So that was quite a significant improvement in, I'm going to say profitability, but reduction in the loss being made by the life insurers in that period. And whilst it's possible that COVID might have been a factor in it, undoubtedly the substantial increases we've seen in premiums over the course of the last 12 to 24 months would be a significant driving factor in the improvement in profitability. But ultimately, that's what APRA is looking to see, is an improvement in profitability, and that hopefully will deliver greater sustainability and pricing stability. So happy to answer any questions on the APRA intervention in the IDII market.
Okay, Phil, we have a couple of questions. How does refresh advice work for self-employed? Example, they've created wealth over that time and have higher insured income. Will medically they only be underwritten for the original policy?
So the question is, and obviously at the time of that refresh, as I said, they have to be financially underwritten, they have to be occupational and pastime underwritten. you've got two different scenarios. One is that their income has increased significantly. And ultimately then it's the client's choice, working with their advisor, as to whether they have increased their cover progressively or they choose to increase it at that point. Now, there's an interesting question there. If they do increase it, does the insurer have the ability to enforce new underwriting of health? That's a really good question. I don't know that I know the answer to that question. It's going to be interesting to see how that plays out. You would hope that that there was going to be some ability to increase their cover. Equally, on the other hand, if you've got a scenario where the person has their income reducing over time, then you would hope that given the way that income at risk is defined based upon the last 12 months, unless it's someone with a variable income, that their cover would have also been reduced to ensure that they weren't paying premiums for insurance they couldn't claim on. So, look, I think it's going to be very interesting to see how this is going to play out. The reality is that APRA decided to give the life insurers another 12 months because they weren't ready. There were too many complications in moving to this model. And I think that question might highlight some of the issues that they're still grappling with.
Thanks, Phil. And the reduction in debt for the industry may have been driven by increased prices, but how much do you think was due to the low uptake of insurance during that period?
So, I'd love to have an actuary to answer that question, but I think the reality in the life insurance industry is that they do need new business to cover the costs of the sales part of the business. So all life insurers have certain costs involved in the sale of new products, and they can defer some of those costs to recognise or to amortise in future years. As the volume of new business declines, their capacity to capitalise those costs is also impacted. So it's a very interesting question that, and you'd probably have to dive into the financial statements of the life insurers to understand whether there has been issues about needing to write off some of those acquisition costs in the first year or not. If we had an actuary here or someone who's been more actively involved in reviewing the financial statements of the life insurers, they may be better positioned to answer it. But yes, I think premium increase has been important, but maybe to some extent there is an offset that flows from the reduction in new business volumes, which we're all very well aware of.
Thank you, Phil. And finally, given that you speak with the different players in the industry, how do you think the insurers feel about what APRA's been? Have they welcomed the model, or do they feel that APRA's just enforced it upon us all?
I'm not really keen on talking on behalf of the life insurers, but the message that we have got is that this was a difficult problem. It was a dysfunctional market in the sense that they were continuing to compete for market share, despite the fact that the business was being sold and generating a loss. And for that reason, I think they have welcomed the intervention of APRA, and no doubt looking at those numbers that APRA reported, where there's been such a significant reduction in the loss, they would be optimistic that it was heading in the right direction and that they can return to a more profitable model. So I don't think the life insurers are going to be dissatisfied with the fact that that intervention has happened. It's disturbed their businesses, it's disturbed the advisor businesses, but I don't think it's in anyone's interest for those losses to have been sustained. Something needed to happen. We want to ensure that the income protection product remains a viable product and it's accessible to Australians. And if it was making such a substantial loss, as all the evidence suggests, then that wasn't going to be sustainable long term.
Thank you, Phil. That's it for questions on that IDII.
All right. So let's now transition back to something that has already commenced, but I do want to talk through this in a little bit of detail. The annual renewal reforms. So the new annual renewal obligation commenced from the 1st of July 2021, this year. We're exactly 2 months into it. And the reality is that we're in the middle of a transition year, and advisors can choose during the course of that transition year exactly when they provide their fee disclosure statements. What they need to do is ensure that they have provided one of the new fee disclosure statements to each client by the 30th of June 2022. Now, I think the important thing is that the day that you provide that new fee disclosure statement to your clients during the transition year defines the anniversary date going forward. That becomes a key date into the future. It's fixed. And the only way to change it is in the event of terminating the arrangement with the client and commencing a new arrangement. So the day you choose to issue your FDSs during the transition year has long-term implications. And even if you did want to try and change the date in future by terminating the arrangement and putting a new arrangement in place, just think of how complex it's going to be to get clients to line up to sign it on precisely the right day. So it's not lost on us, and it hasn't been lost. We wrote to the Minister in January of this year and said that it's flawed. Not allowing advisors to change the anniversary date is a deeply flawed design because it unnecessarily adds to the complexity of trying to manage your FDS program. And obviously lots of advisors prefer to do them in batches, and some choose to do all of their FDSs on the same day. So we are very conscious of that problem of not being able to change the anniversary date. Now, I might just talk on about the transition year. So as you're no doubt all aware, there was a stuff up in the legislation, and the legislation requires that the FDS be provided to the client the day after the period that the FDS covers completes. And that's an obligation that applies, and it continues to apply during this transition year. Once we get through the transition year, sensibly, we go back to having 60 days to issue fee disclosure statements. But for some reason, some of the technical boffins that drafted it left that in there. And it was only as a matter of discussions that I was having with some of our members following a webinar we did in April that it struck me that that's what the law required. So we ended up going through the process of talking to Treasury, talking to ASIC, and eventually the government decided to issue a regulation that allowed advisors to give an estimate for the last 2 months of the 12-month period for the FDS during the transition year. It's only an issue that applies during this transition year. So you've got to have the exact amount for the first 10 months and an estimate for the last 2 months. Now, this was actually really important, because if this wasn't there, any time an advisor provided an FDS during the transition year, even if it was provided 2 days after the end of the period, or the amount was wrong by a small amount because some of the fees hadn't quite flowed in yet, that would have meant that the FDS was invalid, and that would have led to the ongoing fee arrangement being automatically terminated. So it was pretty unfortunate that that issue existed. And I know the solution's not great in that you've got to prepare that estimate, but at least it saves us from a world of other problems that would have eventuated. Now, in terms of what the FDS needs to include, it needs to include the services that were entitled to be provided in the last 12 months, the services that were actually provided in the last 12 months, and the fees that were paid in the last 12 months. That part's the old regime. It also requires the services that will be provided in the next 12 months and the fees that will be provided in the next 12 months. Now, as it's supposed to be exact, obviously that is more complicated in a scenario where you've got a client who's on an asset-based fee arrangement. If they're paying 1% of their assets during the course of the year, the amount of the assets moves up and down. So you can't predict with certainty what the fees will be into the future. Advisors are allowed to provide an estimate for the next 12 months in that FDS, but they need to detail the basis under which they have determined that estimate. So that adds a little bit of extra complexity, obviously, when you're talking about asset-based fee arrangements. Now, you need to, in preparing that estimate, the expectation is that you'll need to take into account known transactions. So if the client is continuing, they've got employer contributions that are coming in, or you know that they will put money in at a certain point in time. It's not just in the super context, or you know that they're going to take money out at a certain point in time. You're supposed to take that into account in preparing your estimate. Now, that just adds an extra level of complexity. Now, I want to focus on something that's actually positive in this legislation, and I guess positive things are few and far between at the moment in the legislation that we're having thrown at us. But there is one positive thing. In the old regime, the client only had 30 days to sign the renewal notice. Now there is 120 days from the anniversary date for the client to sign the FDS. Now, you've got up to 60 days to issue the FDS. So if you took the full 60 days, the client would have 60 days to sign it. If it only takes you 30 days to issue it, the client has 90 days to sign it. So that's quite important. It gives us extra flexibility, and it better enables situations like when the client might be on holidays, if they're unwell, all those different scenarios where it may just be too difficult to get in front of them in the 30-day period that you otherwise have. So if I'm going to focus on something positive, that's the one thing that we can say is actually a positive. Look, I guess other than the inability to change the anniversary day and the stuff up with the transition year, yeah, it wouldn't be great, but we probably would have been able to tolerate it given that it was a mandatory requirement of the Royal Commission. However, I think the experience that many advisors who've implemented it already are having is the consent form and the requirement to have multiple consent forms, to get clients to sign multiple consent forms, to provide those consent forms to product providers. This is adding hugely to the workload in the renewal process. And so if you've got a client who's got, maybe they're a couple and they've each got 3 products, maybe you need to have different consent forms for each product. Maybe there are 3 different product providers. You could be getting the client to sign 7 different documents. They sign the FDS and the 6 consent forms. And they ask, am I paying twice as much because I'm signing twice as many times, or am I paying 3 times because I'm signing 3 different things? That's, I think that's the experience that advisors are having. Also, the experience is that the consent form and the consent form process differs from one product provider to the next. Hopefully, over time, if we can't get the overall regime changed, we will at least be able to see it more automated and more standardised. It's one of the inevitable consequences of a piece of legislation being rammed through so quickly that there's a lack of time to prepare and to deal with some of the complexity in it. This bill was only passed on the 25th of February, came into force on the 1st of July, but we didn't see the guidance from ASIC until June, and that was held up because of the problem with the transition year. The final guidance came after the regulation was issued, and that was virtually a few days before the whole regime came into play. So, yeah, look, I think one of the options in the legislation is that the FDS and the consent form could be merged into the one document, and that probably makes some level of sense if you've got a client who has just one product, or they have products with just one product provider. But as soon as you start talking about multiple product providers, providing each of the product providers with a copy of the FDS has privacy issues. And do you really want them to know where the client has their other accounts with? So I'm sort of conscious that there is an option to merge the FDS and the consent form, but it's problematic because of those privacy issues and the fact that most of the product providers require you to use their consent form. So it would fall over in that sense anyway. And look, this thing became even more complicated on the 30th of June when APRA and ASIC issued a joint letter. And in that, they talked about a super fund trustee's obligations to confirm that advice was being provided for the fees being paid, and that those fees complied with the sole purpose test. And they went as far as to suggest that super fund trustees should do a review of a sample of statements of advice. Now, the AFA has come out very vocally in opposition to that. We think that is a crazy idea, not only for the privacy reasons, but because of it being incredibly inefficient. And of course, a statement of advice does not prove that the services were provided, and it doesn't necessarily prove that the ongoing services do align with the sole purpose test. We have raised those concerns with the government and with APRA and ASIC, and we are continuing to have discussions with them about better ways to solve this particular issue. We recognise that super fund trustees do have obligations, but that certainly should not extend to looking at statements of advice that contain so much confidential and personal information that it should never be in their hands. So that's just one more complexity in this whole regime. I'm happy to answer any questions on annual renewal.
Okay, Phil, we've got a few questions in the same vein, basically asking about what about the amount you disclose if someone's receiving a fee rebate? So, for example, the advisor's ongoing fee is $3,300, but the amount deducted from the person's account is $2,667 because there's tax rebates or there's fee rebates.
The fee rebate, if the fee rebate is paid by the product provider, and that might be because they've got a balance over a certain threshold, that's an offset from the product provider. That's not to offset it's not to offset the fees that are being paid to the advisor. However, the tax treatment of fees is a problem, and advisors might have read ASIC report 636 that talked about the compliance with the FDS and renewal obligations, and they referred to the fact that you need to be precisely right with the fees that you disclose in fee disclosure statements. And in their view, and very definitively, it needed to reflect the amount of money that was taken out of the client's account. So ASIC has a very clear view that you need to disclose what was taken out of the client's account. Now, in our advocacy, and this has been certainly for more than 12 months since report 636 came out, and it has actually been something that's been raised in parliamentary hearings, is that this is a flawed model because it's so prone to risk. You can't be out by $1. You can't be out by a cent. That invalidates the FDS. And that's why ASIC are actually saying that you should manually go into product systems and check that the amounts are right. So we've been talking to the government about the need, Treasury as well, and we've raised it with ASIC about the need for the law to be changed so that there's greater flexibility around that, or there's a margin for error. But yeah, my answer to that question is ASIC expects that it's the amount that comes out of the client's account.
Okay, thanks for that, Phil. And that brings a comment Lynn made that it's hard to accept the legislation is a benefit to our client in that all that's going to happen is our fees need to increase in order to deliver the new fee disclosure statement regime. So, yeah,
Lynn, I'm absolutely on the same angle as you with that. This is a point that we keep making, that these regulatory reforms are increasing the cost of providing financial advice, and in many ways it's and in most ways it's not in a manner that adds value to the client. And the clients are not saying to their advisor, I want to sign 6 forms, I'm not happy signing 4, or I'm not happy signing 2. And I get more value the more signatures I put on a page. And that's why one of the things that we've been advocating in many different forums and in a lot of the work we do in responding to this legislation is the government needs to be listening to existing clients. And I would hope that in the review they do of the quality of advice that's scheduled for next year, they do go out and they listen to clients and they assess whether clients actually value the red tape that is being added as a result of all these Royal Commission reforms. So, Lynn, I can honestly say to you, I totally agree with your point, and that's very much part of the advocacy that we're doing at the moment, is that there needs to be a sensible consumer lens put over all of this, and it's not the lens that comes from the activist consumer groups who represent those people who don't get advice, but it needs to represent those who actually do get advice and who are currently paying for that advice and are faced with the prospect of paying more for their advisor to comply with these new regulatory requirements.
Do you think a way to get around the possibility of having, say, a 1 cent error is just to move permanently to annual agreements and not even have to provide the fee disclosure statements?
I think this is a very delicate issue. And the reason why I'm calling it delicate, and if you read ASIC information sheet 256 on annual renewal, they talk about 12-month agreements. And they talk about whether they are genuinely not an ongoing fee arrangement. And for those who are not familiar with this issue, the definition of an ongoing fee arrangement includes one provision, which it is for a period of more than 12 months. So a number of licensees have taken the view that if we have an agreement for 12 months, then it's not an ongoing fee arrangement, and therefore you don't need to comply with the FDS obligations. Now, why I'm referring you to information sheet 256 is because ASIC have said that they will look at it a little bit more deeply, and you need to be very careful that if you're framing it as a 12-month fixed-term agreement, but in the statement of advice, you refer to services that will be provided into the future, then you're quite clearly setting it up as an arrangement that goes beyond the fixed 12-month period. So have a look at info sheet 256, have a look at how they talk about that, and just make sure that if you are using 12-month fixed-term agreements, there's no risk that you're going to be seen to be avoiding the FDS law because you really are in an ongoing fee arrangement that is expected to last for more than 12 months. Look, I know I've been very strong in the way I've articulated that, but I think it's one of these issues that is an unresolved issue, and we know from the way info sheet 256 was worded is it could well be something that gets looked at closely at some point in the future.
Thanks for that, Phil. There's no more questions, but there's if people want to read it, there's a nice discussion going on in the chat function. Thank you, Phil.
Right, okay, I don't have the chance to have a look at that, but I trust it's a constructive conversation. All right, well, let's move on to the last item we've got on the agenda, which is breach reporting. Now, I'm sure we've got some people on the line who are self-licensed and they understand the obligations of a licensee in terms of breach reporting. But otherwise, we've probably got a lot of authorised reps who have probably not in the past been overly focused on breach reporting. And it's possible that in the past, licensees have reported significant breaches with respect to their advisors, and their advisor was never actually aware of the significant breach report that was made on their as a result of something that they did. So I'm just framing it in that context that you may not have really paid much attention to breach reporting in the past, but I think you necessarily need to be more conscious of it going forward. Now, in the past, it was reasonably straightforward. Section 912D of the Corporations Act defines breach reporting and what's a significant breach, and it refers to it in the context of a basis for it, the number or frequency of similar previous breaches, the impact of the breach or likely breach on the licensee's ability to provide the financial services covered by the license, the extent to which the breach or likely breach indicates that the licensee's arrangements to ensure compliance with those obligations is inadequate, the actual or potential financial loss to clients of the licensee, or the licensee itself arising from the breach or likely breach. So it's very much focused on the licensee, but the emphasis is on the frequency, what it means for the ability of the licensee to comply, and also client loss. So that was the old regime, current until the end of this month, for breach reporting. Licensees had 10 days in which to report a breach to ASIC, but seemingly there was a level of dissatisfaction based upon the view that some of the large institutions weren't reporting on a timely basis and weren't necessarily reporting all the matters that should have been reported. And so that has then led us to the situation where the Royal Commission, along with another major piece of work on the ASIC Enforcement Task Force, has made a recommendation to change the breach reporting regime. Now, I'm not going to mince my words. I think that what they have designed is the most incredibly complex piece of legislation that, in my view, is impossible for the vast majority of licensees to even hope to comprehend. It's that seriously complex and confusing. I'm going to try and break it down a little bit for you, just so that we can understand this. And as we get to the end of this, I'll explain why it's more important for advisors. So they've added a few new elements. So they talk about gross negligence. They talk about serious fraud. Most importantly, they talk about this concept of breaches of core obligations that are significant. And we'll come back to that in a moment. There's also a new requirement to report an investigation that's been going for more than 30 days. So if you haven't finished the investigation by the 30th day, then you have a requirement to report the fact that you are undertaking an investigation. And even should you then complete the investigation after 30 days and decide that there was nothing reportable, then you've got to go back and report that again. So there's layers of complexity in this. Now, in terms of the issue of core obligations, it's a very long journey as you work your way through the different clauses, so the different sections and subsections of 912D to find out what it actually means. But basically, you end up with an understanding that a core obligation is any breach of a financial services law. So then we need to look at, well, what of those core obligations are significant? And it comes down to, and there's a level of deemed significance, which comes with breaches of civil penalty provisions or breaches of offence provisions that are subject to a jail term of 3 months or more where dishonesty is involved, or 12 months or more in other cases. Now, there are some exemptions for civil penalty provisions, and I'll come back to refer that further. So people are probably going to ask me, well, what's a civil penalty and what's an offence provision? So the reality is some sections of the Corps Act do not have a penalty that applies to them. Some are civil penalty provisions, and that means that ASIC can take action against the licensee that ultimately could result in a penalty being awarded. And for some of you, you may have seen some serious penalties applied recently to NAB. There was $18.5 million worth of penalties applied to NAB in respect to fee disclosure statements. That's a civil penalty. There was the case against Westpac where recently there was $10.5 million of penalties awarded against Westpac, where they had some of their superannuation call centre operators ringing people about consolidating advice and the High Court formed the view that it was personal advice, not general advice, and that therefore Westpac had failed in their broader obligations with respect to personal advice. There are civil penalty provisions. Other times you might hear of criminal action being taken against advisors where there might be custodial jail terms. They're what we call offence provisions. So I know I'm going into a little bit of detail here. And the other thing that I didn't mention was the fact that there are certain exemptions from those civil penalty provisions that are therefore not reportable. So here we go. You know, we've got civil penalty provisions, we've got offence provisions, we've got exemptions from civil penalty provisions. The licensees would be going, well, how on earth do I work out exactly what I have to report or not? Now, you can actually find out what the civil penalty provisions are by looking at section 1317E, and there's Schedule 3 of the Corporations Act lists the offence provisions. I'm getting really, really complex here in just trying to explain it. And yes, the government has now come along and given us a regulation to exempt some of these civil penalty provisions from being reportable. And there are 20 civil penalty provisions that have been given exemptions. They include failure to provide an FSG, failure to provide a product disclosure statement, and a number in the fee disclosure statement area. So there are certain things that are not exempt, which is failing to terminate an arrangement where you haven't complied. But some of the other ones in the FDS space have been given exemptions. But what is most important and will have the biggest impact is that breaches of the best interest duty are breaches of a civil penalty provision and would therefore be reportable to ASIC. And that's the thing that we're really worried about. Now, I'm sure that sounds really complicated to everyone, and we have been doing our very best to advocate with the government, with Treasury and with ASIC about the scale of complexity in this. We have been working very hard with Treasury to get as many of those civil penalty provisions exempted as possible, and we have seen some really important progress there. Seeing in the finalisation of that, the exemption of many of the FDS provisions was a really good outcome. But my fear is that licensees, particularly small licensees, will struggle to understand exactly what needs to be reported to ASIC, and I guess they can leverage that facility of compliance approach for a period of time. But it's going to mean that licensees need to be getting more advice from lawyers or compliance consultants, and that's just going to add to cost. Now, there are a few little kickers in this. The first one is that under this new regime, which starts on the 1st of October, licensees have an obligation to report financial advisors from other licensees where they become aware of breaches. Now, this might apply in the case of licensees that are product provider licensees. So if a life insurer suspects churning of life insurance, then they would presumably have an obligation to report that to ASIC. But equally, it would apply to licensees who are recruiting advisors from other licensees. And if, as part of that recruitment process, and obviously you would expect them to do some level of due diligence, they might be reviewing client files and discover something that would appear to be a breach of the best interest duty. Even if it was relatively minor, then all of a sudden they'd be in a position where they needed to report that to ASIC. And we just think that that's way over the top. This is the provision that I referred to as the DOBA provision, and it's quite appropriately section 912 DAB, not quite DOB, but pretty close to it. So that's one thing to be aware of. Now, further to these breach reporting requirements, there are some other related parts of the bill, and I'm referring to the Financial Sector Reform Hayne Royal Commission Response Bill 2020, which was passed in December of last year. And it includes a number of other core requirements, such as where you believe a breach has occurred and there's a likely loss to the client, and that client has a right of recovery, that you need to notify the client. You need to investigate, and you also need to remediate within a very tight time frame. So these additional obligations that sit with the licensee are going to lead to a fairly intense response anytime they receive a breach report, because they have all of these additional obligations that they need to follow through on. Now, the reason that authorised reps are probably going to see more of this is because of those broader consequences. So anytime something is reported, then they may need to be more involved in the investigation and the notifying of clients and that remediation. And also there's one other key reason why you'll have an interest in this, is that breaches that are reported to ASIC automatically would need to be covered in the new mandatory reference checking regime. So if there has been a breach report because of something that you've done as a result of the new regime, then you will see that will end up on any reference check that you get from your licensee in the future. And of course, the other thing is breaches could well end up with the single disciplinary body to have a look at once that new regime is in place as well. So I think that's why it's really important for advisors to be aware of the new breach reporting regime, because the tentacles of it do extend a fairly long way into the lives of ARs should something happen in the future. So that's the conclusion of the breach reporting one, and I'm happy to answer any questions there might be on breach reporting.
Okay, so with breach reporting, there's just one or two. So can't ASIC clearly state the intent of the law we're trying to work with to mitigate some of the legal interpretation of the law? The legal interpretation seems to vary a lot, and therefore licensees will vary on their interpretations. Do you want to comment on that?
And I might just step in to make a point here that ASIC doesn't, except in very rare circumstances, write the law. Their job is to interpret it and to provide guidance on it, which they do through regulatory guides. And I think it's Regulatory Guide 78 is the one on breach reporting. And then they play a role in enforcing the law. So that particular question is about the level of complexity in this. We can't blame ASIC for the complexity in this. They didn't write it. It was done by the government. It went through the Parliament. And I have to say, I was deeply disturbed to see how quickly this went through the Parliament in December last year. This was a huge bill, 159 pages long, an explanatory memorandum of nearly 360 pages, and the House of Review, the Senate, did not even debate it more than tabling a individual speech. So it's deeply disturbing how some of this Royal Commission legislation has made its way and be implemented. And I've been very vocal in all sorts of forums saying that I think this is the most ridiculously complex piece of legislation that I've ever seen. And quite recently, I've asked the Australian Law Reform Commission, as part of their review, to have a look at this piece of legislation. I don't think I can say any more than that. It is completely inconsistent with where I think Hayne went with his interim report, where he talked about unnecessary complexity in the Corporations Act, and yet this is a gold medal performance in complexity in implementing a recommendation of Hayne. So yeah, it's a very poor state of affairs.
Thank you, Phil. And finally, do you think limited advice licenses will continue under these breach regulations?
So limited licenses, which is predominantly in the accounting space, to allow people to give recommendations with respect to SMSFs and class of product advice. So it's a narrow form of advice. Karen, I think we're already seeing that a lot of accountants are getting out of advice, and one of the reasons is the cost of the ASIC funding levy, or it has been one of the reasons. Another reason is all of the education and the exam, and thirdly, I think it's because it's really a part-time advisor role. It's very difficult with all the costs involved in it to make it viable. So we have seen a significant reduction in those limited license authorisations. Whether we expect that to continue, well, I don't know. I mean, I think it has a role. So, and I think it's important for clients to be able to access that sort of advice in the right circumstances. So, look, I don't really know that it's going to end in the right place, but there's certainly a lot of pressure on at the moment.
Thank you, Phil. There's 3 other questions, but I'll given the time, I'll get back to them with the people that ask these questions. So I'll hand over to Julie now. Thank you, Phil.
Thank you.
Thanks, Phil. What a fund of information. Goodness me. I'm sure there's lots of people's heads spinning with the download that you've given us this afternoon. Very much appreciated. And you've certainly not only covered off a lot of ground, but certainly clarified a lot of questions for everyone attending, I'm sure. I'd like to thank everyone for your attendance this afternoon. The session has been recorded, so I'm fairly hopeful that that means that we can share it with those people who couldn't attend, but we'll check on that, and I'm sure Mel will get an announcement out to everyone. Yeah, thanks for attending. We really appreciate it, and everyone enjoy the rest of your, well, afternoon's almost gone, I should say evenings, and take care and keep well, everyone. Thank you very much.